Pricing should be on every executive's agenda, Greg, because it's probably one, if not the most powerful and immediate impacts or levers for increasing pricing and thus shareholder value. Pricing has uniquely disproportionate impact on the bottom line. McKinsey's famous for having done a study in 2003 called The Power of Pricing. And in that, they look at the S&P 500 and they take the average operating profit margin, which was around 12%. In fact, I looked in 2024, it was also 12%. If you have a 1% price increase and price goes directly to the bottom line because there's no incremental cost, that's just over an 8% increase in operating profit.
Years ago, I did an analysis in the early 90s of the Boeing Corporation. At the time, they were producing 747s, which had basically no competition. So I was able to kind of identify, roughly the profitability of the different types of aircraft and different parts of the operation, and sort of allocated cost and capital, and more than 100% of the economic profit of the whole company came from the 747. And the reason was because they could price it very high because it had no competition. It was very differentiated. It had unique things that it could do that no other plane could do. And, a lot of companies, to your point, just you do cost plus pricing, and they would have priced all the aircraft the same. And they wouldn't have made anywhere near as much money as they should have on that unique and very differentiated offering of the 747. And they wouldn't have sold enough of all the other planes because the prices would have been too high. There are big problems with cost plus pricing that I think most people just don't even think about it.